Hello and welcome to a special edition of Market Masters. Is the worst over for markets? That remains the big question. Trump tariffs are the clear and present danger for global markets, while India middle-class tax cuts and potential RBI rate cuts are the two tailwinds which we can see right in front of us.
Absolutely. Today we have the top team at ICICI Prudential Mutual Fund joining us to discuss a whole range of issues, and they have assets under management of around 9 lakh crore rupees. ICICI Pru MF is the second largest mutual fund in India. Equity assets at close to 6 lakh crore rupees and debt AUM at around 2.5 lakh crore rupees. The AMC's equity PMS and AIF assets stand at around 33,000 crore rupees. So, Prashant, we're talking about some very large numbers and big money managers here.
And a big view then as well, right?
Yes.
I mean, and a rounded view, because we've got the equity managers, we've got the debt sort of top leader as well. Let's welcome in Anish Tawakley, CIO, co-CIO equity. Anand Shah is CIO PMS and AIF, and Manish Banthia is CIO fixed income at ICICI Prudential Asset Management Company. Gentlemen, thank you very much, all of you, for being here on this special edition of Market Masters. And I think it's an important and interesting time to get that view from you, because so many people who write into us, who reach out, and the feedback from social media and otherwise seems to all point to this one question. Is the max pain over for markets? The maximum pain over? Is it behind? And while we may not be in a sort of, extremely bullish phase, are we to take that maybe, the worst is behind? Anish, let's start with you.
So if we look at the equity space, right, our view is that the large cap space is fairly valued, but one still needs to be cautious in the small and mid cap space. So that's the overall view. What is that based on? We expect the economy to regain momentum. Right. Our view is that there is no fundamental problem in the economy. There is no structural imbalance that needs to be addressed. Inflation is fine, current account deficit is fine, inflation expectations are reasonable, bank balance sheets are healthy, corporate balance sheets are healthy. So the only thing that's ailing the economy is weak demand. And weak demand is a relatively easily solvable problem if you get fiscal and monetary support. We do expect monetary support to be forthcoming. And if that were to happen, then we do expect the economy to regain momentum. So in that context, the multiples in the large cap space are reasonable. And if one invests for a sort of a 3-year horizon, returns should be reasonable. At the same time, we would say, look, some of the very exorbitant return expectations need to be moderated, right? So people were, over the last 3 years, had got used to very high returns, and that phase might also not be coming, as you were saying.
That's good to hear that you seem quite confident, Anish, on the underlying trajectory of the economy, and you say there's no problem. Let me quickly get in Anand's view on this as well. Anand, so that's the house call. Now, what is the approach that you're taking? And tell us a bit about what you've been doing through the phase of the correction as well. Have you been churning the portfolio a lot, or have you chosen to use this dip to add to some of your bets in infra and related areas that you've liked in the past?
Sure. Hi, good morning. So yes, as Anish said, look, the challenge with the market was there was unprecedented, if that's the word I would use. There was an exuberance in the market. You had a very solid 4-year runs in the market, but more importantly, for almost record 27 months, which is around from June 22 to September 24, we didn't have a 10% correction in the market. So I think the challenge with the market was not as much. I mean, yes, there was a challenge in terms of growth relative to what we have seen in the previous 4 years. The earnings growth rate was also very strong, 35% plus for 4 years. That's also sort of tapered down, but fundamentals in that sense were not like really challenged. The challenge was in the marketplace, which is the valuation and all that. So if I see the data, as on end of February, almost 80, while the markets are down 18.5, 18.8 odd percent, 80% of small caps, as I see, were down by more than 30% from their 52-week high. 60% of mid caps were down more than 30% from their 52-week high, and almost 50% of large caps were more than 30% down from their 52-week high. to that extent, that sort of over-exuberance, we believe, has sort of softened, or we've seen a quick reversal in the market. And to that extent, valuations in individual stocks, individual segments of the market have now corrected to make us a little more comfortable going into the markets, investing into the markets at this point of time. And that's what we've been doing. I think from here on, the key would be stock picking, and which was not even the case, say, 12 months back, that if you were in a certain segments of the market, you have seen a lot more pain than otherwise. And that would remain the case even from here on. Even within the sectors, you will find winners and losers. And to that extent, going bottom up, doing stock picking would be much more important from here in the markets than just going in and out of the markets.
I have to ask you this, Anish and Anand. I mean, I think on the equity side, right? Those comments in early February, which got so much attention, it came from Nair, lock, stock and barrel out of mid caps and small caps. And it generated such a heat and debate all across. And Anish, you run the small cap fund, right? I mean, you guys have been cautious way before, and I think Nair was making this point for a while as well, that small caps and mid caps are very expensive. I mean, your small cap fund has been closed for subscription for almost a year now, Anish?
Yeah, almost exactly a year. You're right.
So, is the views still very strong, or are on mid and small caps? You've said one needs to be cautious here. The preference is clearly large caps. But as Anand also pointed out, stocks have in the small cap space come off very sharply across the board. So, extremely cautious now. A little cautious, but maybe a little more attractive. What's the sense on small and mid caps?
See, I think the best way to put it is the risk-return trade-off is far more favorable in the large caps than in the small caps. In the small caps, you still have stocks that, if you look at price-to-book values, they're excess of 5, 8, and then you look at the moats of these business, the competitive position of these companies, it's not that great. If you look at the balance sheets, there's a lot of, stuff that you typically don't want, very high inventory levels, very high receivable levels. So there's enough minefields in the small and mid-cap space in our view. That's not to say that you can't find anything to invest in, but even in our small cap portfolio, if you look at the published portfolio, we have a fair amount of large caps because we feel that overall they offer a better risk-return trade-off. So to the extent that's regulatorily allowed, we have skewed even the small cap portfolio towards large caps and largish mid-caps.
Right. Okay. So, point taken. Manish, as Anish started by saying that there is no structural problem in the economy. Demand, though, is weak, and that needs to be fixed. And I think your view, Manish, also is that it needs help. The economy doesn't need saving, but it does need help, both on the fiscal side and monetary side as well. So, your thoughts there, Manish?
Right. So, we had a very good run in the economy in the last 2-3 years. Last 6 months has been a period of time where we've seen softening of demand. And, as Anish rightly pointed out, there are no major concerns. There was a period before 2020 when we were going through a balance sheet problem in India. Corporate balance sheet and the financial balance sheet both were under issue, and which is where the economy had a very slow growth for a particularly long period of time. At this juncture, we think that India is still in a mid-cycle. And what we are seeing is a mid-cycle slowdown or mid-cycle correction. And these mid-cycle corrections can typically be addressed if you have the right policy measure. So effectively, RBI has to cut interest rates. And rightly so, we've seen one rate cut, and we'll see more rate cuts till the point that demand in the economy starts to improve. I think additionally, fiscal policy is also important. While, fiscal was very high in 2021-22, the government rightly reduced fiscal deficits, over the next 2 years. But at this juncture, if we concentrate on fiscal consolidation, the problem is the government revenue any which ways will start coming down because of the slow economic growth. And that will put additional pressure on the fiscal. To maintain the fiscal deficit, the government will have to cut expenditure at a point when the government, where the economy is at the margin slow. So I think government should not focus too much on consolidation at this point of time. Allow the fiscal to slip up a little bit and then allow consolidation when the growth is back. So you will have both fiscal policy and the monetary policy working at the same time. And, the RBI has also kind of, given liquidity back to the market. That should help the banks to allow flow of credit in the economy. So the combination of all of these should allow the economy to gain momentum back again. And that is, the broad view.
Absolutely. We've seen the signs of that easing, both in terms of the regulatory stance as well as rates themselves, Manish, in the last just a couple of weeks, right? I mean, latest moves on the priority sector lending definitions and, of course, the rate cut itself. By the way, what is the House view? How many rate cuts this year?
So we expect, 2 more rate cuts from here. And then it will depend on how the economy behaves. The problem with monetary policy is it, works with a lag. So at some point of time, RBI will have to make an estimation in terms of how the forward-looking numbers are and therefore maneuver policy accordingly. At this juncture, given where, everything is, our expectation is that RBI will cut 2 more rates.
More rate cuts this year. Got that. Anish, so now, given what Manish has just said, I mean, let's apply that to the problem that you had identified. You said that the correction was because of market valuations, not because of any underlying economic issues. So on valuations and the earnings recovery, what are you anticipating? We're ending this year with very sluggish single-digit, nifty EPS growth. FY26, what's the recovery? And then do the valuations start looking far more palatable in that sense?
See, basically, but just to clarify one thing, Surabhi, I said that there was a demand weakness in the economy. I didn't say that there was no economic issue, but I said the only issue was weak demand, and that then reflected in slower earnings growth.
Yes.
Right? So, and we do expect demand revival. So, look, I mean, we do think the Indian economy can grow in real terms at 7-ish%, and add inflation to that. So, it was somewhere in the 11-12% range for nominal GDP growth is not unrealistic. And given that corporate earnings typically, follow that kind of growth, that would be the level we would expect nominal GDP to, corporate earnings also to grow at. See, the point on multiples is, I always say that, look, there's no, science to saying what is the right multiple, right? One can make a case for 21, one can make a case for 19. Right? But the reality is if you stay invested for 3 years, even if you entered at 21 and 3 years later the multiple is 19, it's only a 10% spread out over 3 years. So it hurts your returns by 3%. But if you've got good nominal GDP growth, if you've got good earnings growth, you'll still make reasonable returns, right? So the point is, there's no point endlessly debating whether the multiple should be 21 or 19. Reality is it's not outrageously high now, right? That phase is clearly not there. And it could sustain at this level, it could weaken a little bit, but either way it won't change your returns that much over a 3-year period.
Anish, you said earnings growth should be in line with broad GDP growth, but that still means that maybe
no, it could be a little bit higher. It should be, yeah.
Yeah, so in terms of a rough range number, do you think we're getting back to 15% earnings growth in FY26?
Let's see how quickly the economy regains momentum. As Manish said, right, there are lags between policy being eased and the recovery taking place. So, I think we should be picking up momentum, but whether for that year it ends up at exactly 15 or a little bit lower needs to be seen.
Anish, so I want to ask you, Trump tariffs next week, it's the big talking point, but do you believe that it's going to be a disruptor, it's going to be a sideshow? Will it matter in a durable way, or it's going to sort of, pass in a day or two?
No, my view is that tariffs, as far as the overall economy are concerned, are really a sideshow. The economy is broad-based enough that it can withstand some tariffs. So I would make 3 points, right? Firstly, India lowering tariffs is not a bad thing for the economy, right? So even if we chose to lower tariffs, that would be fine. We've lowered tariffs from the 1990s and the economy has done well. So nothing bad happens if you lower tariffs. Second, see the tariff debate, I think trade is one of the most misunderstood economic issues. It's always seen as one country gaining and one country losing. That is not the case. There are winners and losers within the country. And so if the US, for example, decided to impose steel tariffs, all downstream industries which use steel therefore suffer. So you might as well say that the US has made its own manufacturing uncompetitive by putting tariffs. If the US puts tariffs on pharmaceuticals, for example, more than 1/3 of the medicines they consume are supplied by India. There's no other place that can supply at the rates that India does. So what will happen if they put tariffs? The Indian manufacturers are not making supernormal profits. Demand is inelastic. So prices will have to go up. Right? So I think this tariff issue is just being discussed too much. At the overall economy level, I don't think it matters. And the third point, even if there is some reduction in US demand, right, for Indian products, if this domestic demand is strong enough, you can have greater policy support to make sure that the strength of domestic demand offsets the weakness of export demand. So from an overall economic perspective, I don't think tariffs will be the key factor affecting how the economy delivers or the returns that are generated.
Okay, well, that's the broader view, local economy, what the government RBI needs to do, the broader market view as well, and of course a bit about tariffs, as Anish said, perhaps will not have a big impact. We'll take a quick commercial break and we'll come back. We'll ask the top team at ICICI Prudential AMC what they like in terms of sectors. Stay tuned.